it may be the case that say like a tariff on a cost basis is not that much. But if like China is retaliating against the tariffs by saying, okay, we're just not going to send you X, Y, and Z, period, right? That's a bigger problem. Like if you can't get the stuff at all because China's like, we're cutting you off.
Tariffs are the talk of the town. And something that we're going to talk about with Mr. Jonathan Twomley is exactly what is going on in the U.S. economy and what might be the impact on multifamily investing, multifamily building, costs, all of the above. There are so many things going on, and I think you're going to be shocked because some of these may not be as big as you might naturally think. Mr. Jonathan Twomley, how are you doing today?
I'm doing great. How are you today?
I'm doing well. So I just had to have this conversation with you. You play in a world that I can only dream of, and that is the big multifamily space. You are our Ken McElroy for my channel, so thank you for being here each and every week. Where do you want to start? We could talk about costs, building costs. We can talk about just the active building permitting. We could talk about rates or even foreign capital. I have 4 topics I want to riff on. Dealer's choice.
Let's start with costs, I guess.
Yeah. So one of the things that's really interesting, obviously tariffs coming in from Mexico and Canada will have probably the largest impact. There will be some appliances from rest of the world and the like. But when you look at tariffs, one might naturally think that there's going to be a significant cost increase. What do you think is actually and probable might be the impact on an average unit, if you might think?
Well, it's hard to say, but it really depends on how the tariffs are calculated and what they're based on and what the markup is, right? Because I think for some items, like if you're buying them, it really depends on how you're sourcing them, right? If you're buying them direct from the manufacturer, if you have that ability and you're buying them relatively cheaply, like even if they double in cost because of tariffs, they may not affect your overall build cost that much, right? Because if you're looking at a development, then like your biggest cost is like land, right? And labor is going to be a huge cost. Materials, if it's like timber, right, which is a huge input, that is probably sourced domestically, or at least a lot of it is sourced domestically.
Yeah.
Right. It's really the manufactured good, like the kind of low margin manufactured goods like tile and sheetrock and things like that, where I think you're going to see a big impact. And then, with appliances, there's a lot of markup on appliances. So some of the tariff might be absorbed there. It might not fully be passed through. So it just sort of remains to be seen. So the impact on like building, I'm not a developer, so I can't really say this with this is me sort of just reasoning this out, but I think that the impact may be more muted than people are expecting, right? And even thinking about sort of like our hotel redevelopment deals, right? The materials cost is not the biggest component of our costs when we're rehabbing. And I'm just thinking about the rehab costs, right?
Sure.
The labor is really the biggest piece of it by far. And so, I know this is a little bit off topic because we're talking about the tariffs, but if you want to talk about sort of the policies of the current administration, the crackdown, like the hostile environment that is trying to be created or is being created around immigrants is a lot more dangerous to developers and redevelopers than tariffs is, right? Because if something like 1 in 10 construction workers is undocumented, and I'm sure a much higher percentage of them are documented, but they're immigrants, and and what their status is, who knows? But if people decide that they're going to self-deport, right, and there's just not labor available, right, then that is going to be a much bigger problem. And you can imagine a situation in which, particularly say like in a small town where a bunch of non-English speaking laborers come in to work on a project, like that's, it seems where you're likely to get like, some disgruntled neighbor who doesn't like the noise, calling ICE, and then suddenly all your workers get deported, whether they're documented or not. Right. And so that kind of impact can be really devastating. Right.
Yeah.
But the tariffs themselves, just one more thing on the tariffs. I think that like the knock-on effect of tariffs, I mean, what we're seeing, like, so it may be the case that say like a tariff on a cost basis is not that much, but if like China is retaliating against the tariffs by saying, okay, we're just not going to send you X, Y, and Z, period, right? That's a bigger problem. Like if you can't get the stuff at all because China's like, we're cutting you off, or like it doesn't even have to be cutting off everything. They could say like, I don't know what it is. I'm just going to pull something out of the air, but like, what if they say like, okay, we're not going to cut off tile, but we're going to cut off enamel, right?
Right.
So like, well, good luck making the tile because there's no enamel for the tile, right? And so that's I think more of the issue rather than like the tariffs per se.
Yeah, I want to shout out Resi Club and also Jay Parsons, two guys that I follow on X and Twitter, and they've actually done some good work on kind of estimating the cost for multifamily builders. And shockingly, it's, to your point, going to be rather small. The good news is in a typical multifamily build, according to Jay Parsons, I'm doing this from memory, so I'll be off, but close. More than 80% of the bill of materials is locally sourced, meaning inside the United States, which means worst case, 20% of it is currently open for tariffs. They did go on to say that some of that 20% could also be sourced inside. So again, it is very likely that the building costs for a multifamily property will likely be absorbed by the supply chain, to your point. I do think there's bigger risks if this, and it's almost an embargo with China at this point, right? That could become a bigger and bigger problem. So yeah, I think the costs, right, to multifamily builders who are doing hundreds of units is negligible, at least at this point. So I think that is a net positive.
Where you see this coming up though is even if listen, like the problem is for a lot of this is that margins are really thin for developers, right? And it may not make a big difference, like if your cost for a pipe is $1 or it's $1.04, right? Because I think the numbers that they were talking about was like 1 to 4% of the cost.
Right.
It doesn't, in the grand scheme of things, it probably doesn't matter. However, where it really matters is when like people bid a contract and then you've got like, I remember actually during the last Trump administration standing on line at a lunch counter behind a contractor who was building a building across the street and complaining about the fact that he had bid his contract at a certain price. He was a plumber, and now the cost of pipe had gone up, and now he was going to lose money on that contract because it was all because of the tariffs, right? Sure. So it's like that's how it affects things, and as long as there's that uncertainty, it's really the uncertainty about it that creates problems. When you can't underwrite the deal and you can't underwrite your costs, and 5% maybe matters to your profitability, right? Then that's a different problem. That sort of, the tariff impact is small, but the kind of knock-on effects of the tariff.
Well, that's exactly where we're going next, because I think one of the, again, if we look at the cost and we give that a, negligible impact, where I think it will be felt, to your point, is in future building, right? I suspect there's lots of pencil down for developers, lots of delays, pushes. So again, the vacuum or air pocket that Ken McElroy has been talking about pre-tariffs, I think only is going to get worse, right? So there's going to be very little, if any, new building going on as this uncertainty stays high. And if that's true, we could be in a time where we go, 12, 18, 24 months where there's no significant product coming to market. So this is uncertainty is going to impact future building is my thoughts. What do you think?
Yeah, no, I think it's the uncertainty more than anything else. Like that's always the problem. Like, and this is, if you think back to like my old like market psychology presentation that we did together a couple of years ago,
Yep.
Like the bottom of the market is characterized by like maximum uncertainty, right? That's why the market collapses, because people get uncertain about the future. Conversely, at the top, everyone feels certain that it's going to continue to go, or like enough people, like enough of the market feels certain that they know where it's going, and that allows them to take more risk, right? And so, that's not necessarily a good thing either. Like when everybody is so certain, that's usually when you're kind of in the most dangerous, the red flag, right? But but right now we're kind of at the opposite end of that, where you've got, you've had a couple of years in the multifamily industry of like, increasing vacancy, increasing cost, declining rents. And now on top of that, you get the uncertainty about tariffs. It's like another like drip on the bad news. And I think that, just like you said, it leads to that, like, well, we're not even going to try
pencils down
to figure this out until we get more clarity on where things are going.
No, I totally agree. The next thing, if we kind of look at this, and I got this from Jay Parson, and again, Lance Lambert, I like to give credit where credit is due. Earlier, we talked about the cost of the tariffs on a physical goods being inconsequential, very likely. However, tariffs are having impact on rates, and rates are far more meaningful to a developer, right? Because it is variable rate debt, is term debt, it is at the whims of the market. There was talk, at least Kumar, somebody was on CNBC the other day talking about his base case for the 10-year note for 2025 was 5%. So up from where we are today. But he went on to say the risk to his base case is higher, not lower. And he said that he could see 6% 10-year note, which of course would mean 9% mortgages, 12, 13% construction debt. So again, rates matter. And if we continually see the selling of U.S. assets and the reallocation of capital away from the U.S., we could have higher rates. And again, kind of to the earlier point, uncertainty with higher rates means pencils down.
Yeah. And again, I think it's the rates, it's what I think, if the administration had a plan, which I think is up to debate, their plan was, this is going to cause rates to come down, right? Because it'll look like there's going to be a recession. People will cause rates to come down. Also, in times of uncertainty, typically people buy U.S. bonds, right? But what's actually happened is like all these unintended consequences, which is that people, because of the kind of arbitrary nature in which the tariffs are rolled out, people have actually lost confidence in the U.S. government. Right. And so they're
I think it lost confidence in the US. I mean,
but at the end of the day, it's both, right? I mean, it's because who's going to pay those bonds? So it's the US government, right? So so that's what's causing, interest rates to not come down. The opposite effect is happening. People they're selling US bonds, buying German bonds instead, right? They're looking to the yen now. The yen is, last time around, the yen was seen as a source of safety. As indebted as the Japanese government is, like the Japanese people own like 95% of those bonds. So it's basically it's basically like a big debt that they owe themselves. So there's a lot more, and the Japanese have like an astronomical savings rate on top of that. So like their system, even though it looks really creaky, is actually a lot stronger than it appears, which I think like the bond markets recognize, which is why people fled to the yen during the great financial crisis. And there's some signs of that happening again. Thank God, like my safe full of yen cash is like getting better, my safety deposit box, like is more valuable than it was 2 weeks ago. But it's like, it's because of, again, the uncertainty that, that's affecting interest rates, right? Because people are selling bonds and the currency,
I mean, the US dollar, the US right now is acting like a third world country. I mean, hopefully it doesn't change, but typically speaking, when the stock market gets crinky, people rush to the 10-year, not happening. Yeah. The next thing that happens is when rates go up, the dollar is supposed to get stronger. That too is not happening. Yeah, this is clearly a reallocation. And I actually want to quote Ken Griffin. And
just the last piece of this: when people feel uncertain, they usually buy U.S. bonds, right? And that's not happening. So Yeah.
Ken Griffin this morning, again, large Republican donor, the largest, I believe, in the last election, said, Ken Griffin warns that Trump is tarnishing the brand of the U.S. on the world stage.
Yeah.
And I think you're seeing that in financial instruments. So again, it is very interesting to look at rates. Rates going up will again lead to more pencils down, a larger air pocket in the construction of multifamily. And we could be talking about years of below trend product coming to market.
Yeah. And look, I mean, this is kind of what happened in the great financial crisis, right?
For sure.
Like you had, and it led to ultimately a boom in apartments. I mean, it's always cyclical. This is kind of like the way the apartment market works. It's just been particularly violent the last couple cycles because, these have been like debt fueled cycles rather than business cycle fueled cycles. Right. And so I think you're going to have the same, it's just going to look like 2012 all over again, where there's like no construction. You see this buildup of, housing demand that can't be satisfied. And, it'll lead to a good cycle in the future. But I think you got to navigate through all that uncertainty because, there's all these people. So I just want to remind, I keep on seeing all these posts on LinkedIn, which are essentially like, okay, the current pipeline of construction is going to dry up next year or whenever it is. And then boom, there's going to be a boom, right? And it just doesn't work that way. It's going to take, because the financial markets they have a memory of like things being bad. And it takes a while for people to like start feeling secure again about investing. And so you won't see like a boom in multifamily asset prices or anything for a while until like the financial markets start feeling better. And if there's all this uncertainty continuing, that's going to just, there may be a housing shortage, but it's not going to translate necessarily into like elevated values for multifamily buildings, or because if lenders don't want to lend because they feel uncertain, it doesn't matter, right? It's it's not going to matter. And that's what you saw in like 2011, 2012, people look back and like, wow, you could buy apartments for so cheap. Well, yeah, it's because the banks refuse to lend on that stuff, right?
No,
and so doesn't matter how good the economics were. The banks were just like, we're just not touching it. So, and that's going to happen again.
Yeah. Well, the last thing I think about with these tariffs really goes to the U.S. brand that Ken Griffin was talking about. And that is a lot of capital, LP capital, investment capital used to come from rest of the world because U.S. was the shining beacon on the hill. I'm just curious. It is potential that it will become harder and more difficult to raise capital for U.S. purchases, whether that be a new construction or a value add opportunity in the future. So I'm just curious, if this, brand deteriorates and people choose to reallocate capital to Europe or Asia or Australia or South America or wherever, do you see that as a significant risk, or do you think that multifamily just has a brand and the money will keep showing up? What do you think about investor capital?
I don't know how to answer that question, because if you look at like, well, just like the great financial crisis, like there was this huge collapse in the market in the US, and the US caused it. The US caused a world basically depression, like the US housing market did. But then when everybody kind of like went through the mental exercise of like, well, where would you feel safest investing? It still came back to the US, right? Like it was kind of like, you're not going to invest in China. Like China, it's a big risk. Europe is anemic. These other economies, Japan's got its problems. The rest of the world, these markets are kind of too small or too uncertain. Like, where else are you going to go? And it would just sort of kind of circle back. It was like flee the US, but then kind of full circle come back to the US, right? Now, the difference, I guess, between then and now is that it comes back to your point. There was still fundamental faith in the US economy and the US as a system. If like that was why people said, okay, well, the first reaction was fear, flee, right? But then you think about, well, where else are you going to go? And it was because, well, in the long run, this is just temporary. The US will work this out. If the brand of the US is undermined, if there is the idea that, well, like we really can't be sure about the US, anymore because, well, like for whatever reason, what if this repeats itself, or if we just don't know, like every 6 months it's going to change, or every administration is going to be a new policy, then that stops happening. People start looking for, well, where else is safe? And then I think the next logical places are Europe and Japan, right?
Yeah.
Because they're stable. They may not have like dynamic growth, but on the other hand, like at least if you look at Europe, like I think this has been a big shock to the Europeans
for sure.
And I think they're starting to think like, all right, we got to like fix our problems, right? And so if they get their act together, the U.S. will suffer as a result, you know?
Yeah, it's because I think what's really going on right now is obviously not the collapse of the dollar, or we're not going to lose reserve currency. None of that stuff is on the table. But what is happening, I think the ECB, right, European Central Bank, said it best yesterday. We went from an environment where we were over allocated to the U.S. to now neutral. And it is that delta, when you multiply it across all of, friend and foe, that is going to be the change. And that's detrimental to the U.S. So I do expect less capital coming to the United States. They're going to choose to put it somewhere else. It might be 10%, 15% less, but that blended average is going to make it, less capital here just means you got to do other things. So,
and listen, I think China too, like what I've been reading is that China has been diversifying itself away from the U.S. for years now, right? Like so since about 2017, they started like not viewing the U.S. as such a good bet. And so like something like the U.S. is only like 15% of China's exports now. And they hold a lot less of U.S. debt than they used to, right? So because they have made the decision to sort of diversify themselves. And so if the rest of the world is like, hey, we have to de-risk, the US used to be overweight because the US felt so safe. But if that's no longer true, then the US, we're going to have to cut back on our allocation. And I was reading something else interesting the other day about how, the US stock market valuations really depend on the U.S. trade deficit, because it's not just bonds that foreigners are buying, it's U.S. stocks. And the reason that like the value of the U.S., the U.S. stock, the U.S. is like 25% of the world GDP, but the stock market is like 50% of world stock markets or something like that. Like that's not sustainable. That's like having way too high a PE ratio. And, but it's all dependent on the U.S. trade deficit, the strength of the U.S. economy, the faith in the U.S. economy. And if all of that is undermined, then those stock valuations just have to come back to their proper allocation, right? Sure. Which is a big risk to like everyone here, right?
Yeah.
So.
Yeah. At the end of the day, folks, when we think about multifamily, we think about existing stock future. Again, I think the tariffs, the actual physical goods that go into building, impact will be negligible. However, the uncertainty caused by the tariffs, the loss in faith of the brand in the U.S., those will have impacts. Rates will also be more important than costs. Jonathan, where can people follow you?
Yeah, well, come follow me on LinkedIn. That's where I'm always active and always happy to engage.
Thank you, buddy. I appreciate you.